This is Nightly Business Report with Sue Herrera and Bill Griffin.
Deal reached. President Trump says a 2-year debt ceiling agreement is done, lifting a cloud that's been hanging over Wall Street.
Record settlement. Equifax will pay hundreds of millions of dollars to end multiple investigations. But does the fine have much bite?
King of the box office. Disney dominates again. Can anything stop it? Those stories and much more tonight on Nightly Business Report for Monday, July the 22nd.
Good evening, everyone, and welcome. Stocks begin a big earnings week with slight gains, but the focus was on Washington. Late tonight, President Trump said a 2-year deal to increase the debt limit has been reached. That averts a default on U.S. debt and removes a dark cloud that was hanging over Wall Street. Raising the debt ceiling allows the U.S. to pay its bills. If it's not raised, the U.S. defaults, which economists say could trigger chaos in the global markets. Contessa Brewer joins us now. Good evening, Contessa.
Good evening, Sue. Yeah, it appears we may have a deal on the debt ceiling standoff. Late tonight, President Trump tweeted, "I am pleased to announce that a deal has been struck with Senate Majority Leader Mitch McConnell, Senate Minority Leader Chuck Schumer, Speaker of the House Nancy Pelosi, and House Minority Leader Kevin McCarthy on a 2-year budget and debt ceiling with no poison pills." The president goes on, "This was a real compromise in order to give another big victory to our great military and vets." The negotiating has been intense over how to categorize the VA mission, whether it should be considered military or non-military funding, which by law must remain equal. Now, Speaker Pelosi had wanted a 2-year deal and reportedly was negotiating last minute from a delayed Delta flight in Detroit, working to get this agreement before the House leaves for August recess at the end of the week. Both houses still have to vote on the deal. It's largely expected to pass. Bill, Sue.
Thank you, Contessa.
And before the U.S.-China trade negotiations resume, one of the major sticking points to a deal was discussed in Washington today. Various tech executives gathered at the White House to discuss the administration's ban on Huawei, the Chinese telecom company that finds itself at the center of the prolonged trade negotiations. American companies rely on Huawei's components. They are concerned that the ban will impact their ability to compete and roll out the next generation of wireless technology called 5G. Remember, back in May, President Trump banned Huawei from doing business with U.S. companies, but since then, some of those restrictions have been eased.
The FTC will reportedly announce its $5 billion settlement with Facebook as soon as this week. As we've reported, that deal would settle user privacy claims against the company. It would also create an internal oversight board.
And Equifax has agreed to a record settlement with federal and state regulators to pay for its massive data breach of 2 years ago that affected nearly 150 million Americans. That sent shares of the credit reporting agency fractionally higher today. Kayla Tausche has the details.
In the biggest payout for a data breach yet, Equifax will pay regulators, states, and consumers up to $700 million in fines and reimbursements after account and financial information for 147 million consumers were exposed. Under the terms of the deal, Atlanta-based Equifax will pay $100 million to the Consumer Financial Protection Bureau, $175 million to state attorneys general, and up to $425 million in customer payouts for the time and money spent monitoring their credit to make sure their information wasn't being sold. Estimating how much those grievances cost is more art than science, according to the Federal Trade Commission's privacy chief.
It's very difficult to tell because it's very difficult to trace a particular incidence of identity theft back to a particular breach.
Please repeat after me.
On Capitol Hill in March, Equifax CEO Mark Begor, who took the job after the breach, expressed remorse.
There were controls in place. They clearly weren't strong enough.
Today, he said those controls are stronger, but the industry is still on alert.
We get attacked every day, and we're preventing those attacks, but they're going to continue. And it's really a war that's being attacked on every American company.
Asked why no executives were named in the settlement, FTC Chairman Joseph Simon said they weren't at fault.
There needs to be a specific involvement. That's what we're looking for.
Consumers who may have been impacted by the breach will be able to apply for relief shortly once a court approves the settlement. Maryland's Attorney General, one of 48 who signed on, said it's not just adults that need monitoring, but kids too, whose information is even more attractive to cyber criminals. For Nightly Business Report, I'm Kayla Tausche in Washington.
So how did federal regulators come up with that settlement number for Equifax, and does it really benefit consumers? Joining us to talk about this tonight is Raj Dante. He is the former deputy director at the Consumer Financial Protection Bureau, and now he is currently managing director at the venture capital firm Fenway Sumner. Nice to have you with us, Raj. Welcome.
Thank you for having me.
Well, what about this so-called formula that is used to come up with numbers like this, and also the number of consumers involved in this particular case? What did you think of the number that they came up with for Equifax?
Well, it felt a little bit light to me, but it's certainly a complicated process in a negotiated settlement like this. Just to give some context, I mean, what really drives where a settlement like this comes out is, how strong is the government's case in the first place, and how many customers are implicated, and for each one of those customers, how severe is the damage, and finally, how bad is the conduct? And I think in a case like this, it seemed to me that some of the factors went a couple of different ways. Like on the one hand, it was a huge breach, 140 million plus customers affected. And there's no doubt that Equifax did some pretty basic stuff wrong when it comes to data security. But on the other hand, I would be surprised if there are Equifax executives sitting around thinking, you know what, let's put consumer data at risk. That's unlikely. Right. And the fact of the matter is, the sad reality is because there have been so many breaches, take your pick, Target and Saks and even the federal government's own Office of Personnel Management, it's hard to trace any particular fraud back to any particular breach. And that's what makes calculating this stuff kind of hard.
Of the $700 million, up to that, $425 million to reparations for consumers, but they have to prove that there was actual financial damage done for them to get the money back. But how do you prove that, and how much do you think anybody should expect to get from this?
It's no picnic to prove these things up, which is why it is, I think, that some of the early coverage talking about how consumers could get up to $20,000 each feels to me a little misleading. I mean, just the math is, if there are 140 million people involved, not all of them are getting $20,000. That would be $2.8 trillion, or 4,000 times as much as the $700 million that we're talking about here. The reality is that consumers will see some benefit, for sure, by virtue of having identity theft monitoring and credit report monitoring. That's worth something. That's something a lot of people should be doing anyway. But I would not get carried away with the sheer magnitude of monetary relief for customers, because it's just math. There's not that much here to go around.
You mentioned some of the previous breach as well. Does that not make it even more complicated for consumers to prove the fact that if their data was stolen, it was basically this company's fault, and not, say, the previous hacks at other retailers?
I think it would be really, really hard. And frankly, it was so easy to do, it would probably be easier for the FTC and the CFPB to do than any individual customer. So that's why I think this notion of proving up individual monetary relief for individual consumers feels like a paperwork burden way too far to really make a big difference.
Raj Dante with Fenway Sumner, thanks so much for joining us.
Thank you for having me.
And a little bit later in our program tonight, a look at what some pharmaceutical companies are doing to shield themselves from potential legal liabilities related to the opioid crisis.
As we mentioned, stocks rose slightly to start this earnings-heavy week. Investors are also bracing for a number of fresh economic reports, which should shed light on what the Federal Reserve may do when it meets next week. That's coming up pretty quickly. Today, the Dow Industrial Average rose 17 points. We're at 27,171. The NASDAQ added 57, and the S&P 500 was up 8. But if you look at where the money is flowing right now, an interesting trend is taking shape. Mike Santoli found it out for us.
Are investors paying too high a price for the promise of certainty in the markets right now? Well, with global growth faltering and central bank policy shifting fast, investors have rushed into areas they believe offer a more predictable ride. These include bonds, the supposedly boring stocks of stable companies, and the dominant growth companies in technology. Some $250 billion of fresh cash has gone into bond funds this year, even as government yields sit near multi-year lows. The shares of consumer staples and other slow-growth dividend-paying blue chips are up even more than the S&P 500's 19% gain year-to-date. And the giants of the digital economy, such as Amazon and Microsoft, with their sturdy and open-ended long-term growth outlooks, have powered large-cap growth indexes higher by some 24% this year. On the losing side are cheap stocks in banking, transportation, and pharmaceuticals that need either the economy to quicken or policy shadows to lift. While the powerful preference for perceived certainty right now is understandable given slowing growth and mixed messages about Fed policy, there's always a chance that these trends can go too far. A similar pattern in 2016 reversed violently after growth and inflation expectations shot higher following the presidential election, for instance. Now, it's tough to know if a similar turnabout is on the way again soon, but it does pay to remember that nothing is certain in the market, and it's possible to overpay even for what seems to be a sure thing. For Nightly Business Report, I'm Mike Santoli.
Two major credit rating agencies are cutting their outlook for Boeing. The reason? Concerns about the 737 MAX. And that weighed on the stock price in today's session. Phil LeBeau has more.
4 months after the FAA grounded the 737 MAX, credit firms are raising concerns about how long it will take to get the planes back in the air. Moody's and Fitch both cut their outlooks for Boeing from stable to negative, citing issues surrounding the 737 MAX, including the possibility of delays in returning it to service. Fitch says the 737 MAX situation will reduce much of the financial cushion Boeing has at the current A rating. And for its part, Boeing recently reaffirmed its production schedule, as well as its assumption the MAX will be flying again in the fourth quarter. What remains unclear is whether testing and approval of software, as well as pilot training for the MAX, will actually happen this fall. Over the last 4 months, airlines like Southwest have repeatedly set dates they expected to resume flying the MAX, only to push them back as Boeing ran into issues fixing the plane. Just last week, Boeing said issues with the 737 MAX will lower the company's Q2 earnings by at least $5 billion. That impact, plus what's next for the MAX, will be a focus of questions analysts have for Boeing executives after they report Q2 earnings on Wednesday morning. Phil LeBeau, Nightly Business Report, Chicago.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Micron Tech tonight. They were upgraded to buy from neutral at Goldman Sachs, with the analyst citing a positive outlook for global memory chip demand and the potential for better pricing in the third quarter. Price target now $56. That stock rose more than 3.5% today to $47.19. Qualcomm was downgraded as sector performed from outperform at RBC Capital. RBC said it cannot recommend this stock until the FTC's antitrust ruling is complete and the outlook becomes clearer. Price target $79. The shares rose more than 1% today to $75.95. Apple's price target was raised to $247 from $231 at Morgan Stanley. The analyst says the stock is attractive ahead of its earnings. That report is due out next Tuesday. The rating does remain overweight. The stock was up more than 2% today to $207.22. And separately, late today, the Wall Street Journal reported that Apple is in talks to buy Intel's wireless chip business. That sent shares of Intel initially higher in after-hours trading this evening.
Still ahead, China's answer to the NASDAQ has a crazy first day. This is a critical week for Johnson & Johnson as the company faces thousands of lawsuits related to its talc-based baby products. Now, during a hearing that is expected to last more than a week, a trial judge in Trenton, New Jersey, began evaluating the scientific evidence presented by plaintiffs who claim the products caused their cancer. And J&J has asked the judge to exclude from any future trials the opinions of 22 experts retained by plaintiffs. The plaintiffs' lawyers have asked the judge to deny that request, arguing that their experts are qualified. The judge's decision will determine the future of roughly 12,000 cases that have all been consolidated to expedite the process.
New information recently surfaced about the opioid epidemic. A drug enforcement database now shows 76 billion oxycodone and hydrocodone pills flooded U.S. communities between 2006 and 2012. That database is a key part of a massive legal case in federal court in Cleveland, where a judge is pushing for a settlement. Some experts say it could top $100 billion. Meg Terrell has the story of one drug company's strategy to shield itself from potential liabilities.
Mallinckrodt Pharmaceuticals is a UK-based drug maker with U.S. operations in Missouri. It's best known for selling the billion-dollar drug HP Acthar gel. But last week, it was also revealed to be the largest manufacturer of oxycodone and hydrocodone pills over a 7-year period, supplying U.S. communities with almost 29 billion pills. As a federal judge in Ohio pushes for an opioid settlement, that could spell billions of dollars.
You can actually get to a bear case scenario for Mallinckrodt that's in excess of $5 billion. That's not our base case scenario. That's a worst case scenario.
But Mallinckrodt has a plan that would shield its main business from those potential liabilities. It aims to spin out its generic drug division, which contains oxycodone and hydrocodone, into a new company. With it, company executives say should go any potential liabilities from selling opioids.
With regards to the risks and liabilities, again, I think we've been very clear since we announced our intent to spin, is that risks and liabilities will follow the assets.
Mallinckrodt notes it's been considering how to separate the two businesses for years and doesn't cite the liabilities as a driving factor. The company declined to comment for this story, directing us instead to public documents. But it wouldn't be the first company to try to benefit from a sale or spin-off of a business with legal risks from opioids. In 2014, consumer products giant Reckitt Benckiser, which sells brands from Clear Cell acne products to Enfamil baby formula, spun out its pharmaceuticals unit into a company called Indivior. Earlier this year, Reckitt Benckiser agreed to an almost $1.5 billion settlement with the Department of Justice over sales practices for the opioid product Suboxone. But the company wasn't named when the Justice Department indicted Indivior, so Berenberg analyst Patrick Trucchio calls that a win.
When you look at that, the way that has kind of resolved, at least for Reckitt, one could argue that it was, strategically it made a lot of sense. And now on the legal side, they have a settlement and they can now move on and focus on their business.
Mallinckrodt says it aims to complete the spin-out before the end of the year. The trial in Cleveland, if it doesn't reach a settlement, is set to begin in October. For Nightly Business Report, I'm Meg Terrell.
Vail Resorts heads east. That's where we begin tonight's market focus. The ski operator is buying Peak Resorts for $11 per share, or a little bit more than $260 million. The move adds 17 more ski areas in the Northeast, parts of the Ohio Valley, and Missouri. The stock rose more than 4% to $235.27. Halliburton posted better than expected earnings but saw a drop in revenue. Growth in its international business helped the results at the oilfield services company, but its North American unit sales slumped. But shares rose more than 9% to $23.74.
Microsoft is investing $1 billion into a startup called OpenAI, which was created by Tesla's Elon Musk. Both companies are going to collaborate to bring advanced technologies and artificial intelligence to Microsoft's Azure cloud platform, and Microsoft in turn is going to become OpenAI's exclusive cloud provider. Microsoft rose more than 1% in today's trade to 138.43. And then after the bell, Whirlpool beat expectations thanks to strong North American sales and higher profits for its washing machines and kitchen products. The appliance maker also raised its full-year guidance. Shares were volatile in the after-hours trading, to say the least. They closed the regular session up a fraction to 148.35.
China's new stock exchange had a wild opening day. Stocks doubled, tripled, and some more than quadrupled in value. The exchange is China's answer to the NASDAQ, and there are a few reasons why it launched right now. Eunice Yoon is in Shanghai.
China unveiled its own version of the NASDAQ today. The Science, Technology, Innovation Board, or STAR, is meant to lure listings away from New York and Hong Kong here to Shanghai. 140 Chinese startups making everything from lasers to solar cells have applied for the board, with 25 going public today. The STAR market is seen as a big step towards capital market reform here, and it solves two big problems for Chinese startups. The IPO rules have been so strict that companies that don't make money, like Starbucks rival Luckin Coffee, choose to go to the NASDAQ. And venture capitalists who have been scared of investing in Chinese tech now see a clear way to get their money out. Chinese firms that list on the Star don't need to prove that they make profits, for example. The government plays a smaller role in the IPO approval process, and the stocks are traded more freely. Foreign investors can buy into the market on a restricted basis, as with all Chinese markets. I spoke to the chairman of one startup who said that he hoped more foreign investors would eventually take part to help professionalize the exchange. But for now, most international fund managers say they're steering clear. With the stock prices so volatile, most of the stocks ended the day higher by 140%. One other reason that startups are looking towards Shanghai, the chairman said that it could be easier to list here with trade tensions so high with the United States. For Nightly Business Report, I'm Eunice Yoon in Shanghai.
And coming up, Disney dominates the box office, and this may just be the beginning.
Disney set not one record this weekend, but two, and that helped lift the stock, which is already up more than 25% so far this year. And as Julia Borston reports, Disney's best days may be yet to come.
King of the box office, Disney's Lion King remake opening with $185 million at the domestic box office. That's a July record, the second largest opening of the year, one of the top 10 openings of all time. And if you consider it an animated film, this is the largest animated opening ever. These records are all the more impressive considering the film's negative reviews. It scored just over a 50% critics rating on Rotten Tomatoes.
The genius of what Disney has done actually is they are going for these films that are review-proof, right? You've got Lion King, Aladdin, Toy Story. They're well-known. People want to go out and see them regardless of what the reviews say.
And Disney hit a second record this weekend. Avengers Endgame topped Avatar to hold the record for the biggest box office worldwide, $2.79 billion.
Lion King's massive opening numbers, including a worldwide gross of well over $500 million, further builds Disney's box office dominance. The studio is responsible for over a third of domestic ticket sales this year, dwarfing Warner Brothers and Universal in second and third place with about 14% each.
Disney is just blotting out the sun for all the other studios, and everybody else is kind of punching up right now.
What have you done? And Disney has three other films that are expected to be huge this year. Maleficent, Mistress of Evil in October, Frozen 2 in November, and then Star Wars, Rise of Skywalker in December. But this weekend's win could also help rival studios by getting audiences back in theaters, with Sony's Once Upon a Time in Hollywood opening this Friday and Universal's Fast and Furious presents Hobbs and Shaw the following Friday. And Disney is poised to dominate the box office for years to come. At Comic-Con this weekend, it unveiled 5 Marvel movies debuting in the next 2 years. With another 5 Marvel movies set to launch on upcoming Disney Plus in that same time period, we'll see how Disney uses all this superhero power to drive subscribers to its new streaming service launching in November. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Let's turn to David Hager right now to talk more about Disney's dominance of the box office and where it goes from here. He's senior equity analyst at Edward Jones. Thanks for joining us tonight.
Thank you.
What a juggernaut. I mean, Julia is pointing out that they've got a slate of more Marvel movies coming out over the next few years. You've got more Star Wars movies, some of the classics that they're bringing back. I mean, are there any weaknesses in the Disney studios right now that you can see?
Well, certainly from the studio point of view, the company looks poised for a very strong rest of the year with the upcoming movies still to go. And obviously, so far have been pretty much blowing all the other studios out of the water. But certainly the studio business can be tough in terms of when it gets to be next year, how do you repeat that success and continue to show growth? And so, certainly that will be a challenge as we move into 2020 and see what Disney can pull off next at the box office.
Obviously, they have a huge slate, as Bill pointed out. But if you had to pick a major competitor for Disney, especially now that they've combined with those Fox assets, would it be a Netflix? Who would it be?
Well, certainly it depends on which part of the business you're talking about, and we see Netflix certainly as a large competitor, somewhat a competitor in their traditional media business, where unfortunately we're seeing losses of pay TV subscribers, which is impacting that part of the business, and so that's where then Disney's going to tap into that strong vault of content that they have with the Disney Plus service that'll be rolling out in November, and Disney will then be looking to start driving growth from recurring revenue from the Disney Plus service and really tap into that strong content that they've got.
Is the strength of the studios enough to cover some of the potential weaknesses elsewhere in the business? For example, I mean, it's a good time to be starting a streaming service that might be losing money for a few years while you got a studio that's making all the money right now, right?
Right, and that's one of the nice things Disney has is they've got kind of multiple levers they can pull in terms of driving growth in the interim. Even the traditional media businesses are not seeing revenue declines. They still are flat to modest growth and a good cash flow generator. And then the parks business is seeing very consistent growth as Disney invests a lot in the parks, and you're rolling out new attractions. The new Star Wars attraction at Disneyland, right. It's been very successful. So, and then finally, those parts of the business I think can help support the investment that'll be needed for Disney Plus.
Walt Disney's out there smiling somewhere, that's for sure. David Hager with Edward Jones. Again, thanks for joining us tonight.
Thank you.
And before we go, here's a look at the day's final numbers from Wall Street. The Dow rose 17 points to 27,171. The Nasdaq added 57, and the S&P 500 was up 8. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Welcome back, by the way.
Thanks. It's great to be back.
Have a great evening. See you tomorrow.